This is the 51st episode in our Crossing Thin Ice podcast series brought to you by Actuarial Risk Management. Twice each month, we tackle risk topics and the risk management of insurers. I'm Max Rudolph, and today Dave Ingram will be discussing the practice of building your own factors for your own risks. This expands on earlier podcasts where we focused on the importance of right-sizing an enterprise risk management process. The NAIC and rating agency capital models are developed based on an average company, but no one is average across every risk. Your mitigation efforts and preferred risk metrics may also reflect company preferences. Our aim for the Crossing Thin Ice offerings is to help with your ERM program and general risk knowledge. We hope that you already take advantage of our quarterly newsletter and webcast and encourage you to share with anyone interested in continuous learning and risk management. We welcome your feedback. As a reminder, nothing in today's podcast is intended to be investment advice. We are here to provide educational material on risk topics without getting lost in the weeds. Let's get started.
An own factor risk formula, or OFRF, can be a very powerful way to estimate and explain an insurer's risk capital position. It can be more accurate than the standard formulas used by regulators and rating agencies, and light years more explainable than a stochastic model. The OFRF looks just like the NAIC's risk-based capital, or RBC. It's a series of multiplications of an exposure amount times a risk factor. For risk related to pricing and claims of property and casualty products, the calculation would usually be premium times a risk factor, where the risk factor varies by line of business. For an investment-related risk, like variations in value of the stock market, the calculation is the market value of the stock portfolio times a risk factor. One key idea is that the risk factors are all calculated for a similar degree of adversity, such as a 98% likelihood loss. This is the general idea behind the RBC formula, but in many cases the risk factors are calculated on the average to be applied to the entire insurance industry. Sometimes there are company-specific adjustments which may or may not be similar in outcome to a true bespoke risk capital formula. The own factor development can take several routes. The first time I was asked to create a set of own factors, I was asked to research the history of the company and identify the worst one-year loss for each major risk of the company. That meant looking at the 1918 influenza pandemic for mortality and the Great Depression for investment-related losses. I then calculated the factors based upon the losses at that time compared to the exposures at that time. A set of stress scenarios can be used for risk where it is believed that the true potential losses have not yet happened. In another situation with a company that was a little over 25 years old, we developed the company's experience with each risk factor over their entire history and determined the standard deviation of their experience. For most risks, we then set the risk factor to be 2 standard deviations. However, we recognized that an implicit assumption of normal distribution of gains and losses was inadequate. Some risks, like their natural catastrophe risk, were fatter-tailed risks. That means that they would expect larger losses than a normal distribution would suggest for the tail losses. For those risks, we set the factor to 2.5 or 3 times the standard deviation based on knowledge we had about the range of industry losses for those types of risks. A third approach is to use a full or partial stochastic internal capital model to set the factors. When a company has spent the time and money to develop an internal capital model, they usually want to use it. However, the time that it takes to update a capital model for quarterly statements usually means that results will be available too long after the end of the quarter to be actionable management information. Instead, those results become mostly a part of historical analysis for many companies. They can use the own factor approach to estimate the quarterly risk capital amounts using factors that were created from the most recent model run. These results can be ready as soon as the exposure factors are finalized for the quarter. The magnitude of the changes to the factor from model run to model run can also be important information for the modelers, indicating where the model is most sensitive to changes in the exact composition of exposures and/or external conditions. The own factor approach can be the basis for a clear explanation of changes in model outcomes from period to period. Those changes can be broken into volume variances and rate variances. We are doing more or less of the risk-making activity, or those activities are becoming more or less risky, is the clear first-order explanation. In addition, the factors can be compared to the industry-level RBC factors to provide a simple comparison of the riskiness of your business to the riskiness of the industry. This approach means that the risk calculation is more closely related to the company's own risk-taking rather than to broad industry averages. The one drawback is the situation mentioned previously, where the factors are changing significantly from period to period. If that is happening for major risks of the company, then the more complicated process of full or partial internal capital modeling is probably called for. That need raises an interesting issue about the inherent variability of your business model. It means that the way you are choosing your risk makes them significantly unpredictable. Any planning related to your risk will be tricky, to say the least. But if your business is tamer than that, you can get a significant benefit out of using this own risk factor formula in terms of both ease and speed of calculation and ease of communication. Risk management for insurers is now more complex than ever, and staying ahead requires more than traditional approaches. That's where AI comes in. Our artificial intelligence-assisted risk management solutions provide a powerful edge by delivering insights that are faster, deeper, and more actionable. From stress testing and scenario planning to risk environment scanning, staff training, and risk culture enhancement, our tools are made to be tailored to meet your specific needs. With AI, you can anticipate emerging risk, refine your strategies, and make decisions with confidence, even in uncertain environments. Let us help you turn complexity into clarity and risk into opportunity. Take your risk management to the next level with AI.
So Dave, what are typical levels of stress used for these factors that are developed internally?
Well, Max, I like to talk about stress tests in terms of three levels. I've mentioned these before. I'll mention it again. The lowest level of stress I would call normal volatility. That's kind of the range of results you'd get over a 5 or 10 year period when nothing unusually bad happens. So that's kind of one standard deviation, perhaps. The second level of stress that I talk about, I call realistic disaster. I stole that term from Lloyd's of London. They use that for their stress tests. Think of that as a loss that you might experience over the worst situation that happens during your career. That's probably the level of stress that is most commonly used by companies. It certainly is the worst level of stress that most management teams of their own accord would think about. The third level of stress I like to call worst case. It's actually not technically a worst case. Most actuaries that I say this to point out to me, but it is something that's significantly worse than a realistic disaster. It is the kind of scenario that a regulator will often ask about. When I've done ORSA work with companies, we focus on usually stress scenarios that are realistic disasters. And what I've told companies is you have to include something that's a worst case. Otherwise, my uniform experience is the regulator comes back and asks for it. So that realistic disaster might be a 2 standard deviation loss if you're looking at it to calibrate it from your own experience that way. It's similar to a VAR kind of idea. I guess the very first time I ever did one of these own factor formulas The company that I was working for at that time was about 125 years old. My instructions were to go back to the history of the company and look for the worst experience for every single risk factor that the company had had over its entire history. We calculated mortality factor based on the 1918 flu pandemic. We calculated credit market stress from the Great Depression. We calculated equity risk from the Great Depression as well. And interest rate fluctuations. I guess the first time we did that, we didn't even realize that interest rates fluctuated. Because I think at that time, interest rates were moving very gradually over very long periods of time. Eventually, we did put in interest rate stresses based on, fairly recent gyrations of interest rates. For instance, in 1994, interest rates jumped up 3% in a year. And so that could be your worst case scenario there historically.
So Dave, one of the things when I was at an insurance company that we spent a lot of time thinking about was how to deal with diversification. How are companies dealing with that in these own factor formulas? Do they ignore it, or do they create some type of a formula like risk-based capital?
It differs, I think, between life and property and casualty companies. For the most part, property and casualty companies tend to run their business in such a way that the business model requires diversification. They will tend to always factor diversification into their calculations. It may even be affecting their calculations for individual products. Life companies tend not to think of themselves as being that dependent on diversifications. In my experience, at least, maybe I'm a little out of date on that. An awful lot of companies do use the formula that the RBC uses, which assumes that some risks are 100% correlated and some risks are 100% uncorrelated, and there is no partial correlations allowed in the model. I've recommended to companies that there's no science to how people are doing correlations, that there is complication to how they're calculating it sometimes. Some people using very complicated mathematical approaches to calculating diversification, but they take this complicated approach and they apply correlation factors that are rounded to the nearest 10%, which in my mind is not science at all then. That's really pulling numbers out of the air. I've suggested to folks another way you could look at it is do the calculation assuming all risks are correlated, do the calculation assuming all risks are uncalculated, place yourself on a sliding scale somewhere in between there. Usually people like to be somewhere in the 50 to 75% correlated area because that feels safe. I saw something in the news recently, a company saying, oh, look, we have enough capital, we could deal with this stress, and this stress all at the same time. That's a company that has a lot of capital and probably isn't using diversification.
One of the things that I used to do was, as a stress test, to use the factors as if they were 100% correlated. Then, if everything went bad, how much would that impact our capital needs? And that would give us comfort that we were still okay even in a bad situation. Maybe in a fast-moving environment, how do you ensure that risk factors remain accurate and actionable when things are changing so quickly?
That's a tough one. It's not very easy to do. You have to realize there's two things that will drive those risk factors different. One is the external environment and how risky the underlying activities you're doing is, and the other one is the structure of the business that you're writing. The extreme example of that are reinsurance transactions, where any one reinsurance transaction might have a very different risk profile to another one, depending on how much risk is being retained by the company that's ceding the business, and what kind of caps there are on the liabilities of the company that is the reinsurer that's taking the risk. And so that there isn't any way of coming up with a factor for a reinsurance company that's doing business like that could work from one case to another. So when you're talking about the variations coming from the environment, that's very hard to do. And you have to realize that if you're looking at the standards here, the way that the calculations are done by the regulator and the rating agencies never or only changes, for the rating agencies, it may change in a 5 or 10 year period. So they're not paying any attention at all to a rapidly changing environment that in terms of their formula. That may be the best case for a company that isn't doing a lot of really complicated monitoring, is reflect that changing environment of elsewhere, perhaps by changing their risk tolerance or their risk limits. So, Max, let me ask you a question. Once capital levels are set, how do you think they should be presented back to the product lines and to the asset managers?
Well, this is a pet peeve for me. In way too many cases, subsidiaries, investment managers, and product lines, they create the data for the corporate team, and then they never hear anything back. If the product teams understand how their work fits into the aggregate results for risk, I think it'll help them to adjust and plan future tactics that align with the strategic vision of the CEO. I think it's valuable to have alignment from that top down. So Dave, is the next step after adopting an own factor model to go to a dynamic factor model or DFM?
A dynamic factor model is in my mind a version of a stochastic model that you would be updating regularly. That dynamic factor model is probably what you'd want to do if you already have a stochastic model. You can use this own factor model in that case so that you can produce capital values much faster. Turnaround times for full stochastic models where you're updating assumptions can be a month, can be even more than a month. It may mean that by adopting this own factor model, you can take your time and do a better job with updating your stochastic model so that it doesn't have such a tight time frame, because it's a month and a half after a quarter's over is pretty late for reporting something. So if you use this own factor model with last quarter's factors, you can get a pretty good estimate of what your quarterly capital numbers are. So you're always running with a makeup sort of step there. So I think that's the best way to use this own factor model in a dynamic environment. And this is actually part of an answer to that previous question about keeping up to date. If you don't have a stochastic model, it's hard to do this. But with a stochastic model, it's just a timing issue.
You can't take the time to adjust every factor probably because of time constraints and other things. And some of the factors maybe you're able to pull in that make sense and you're comfortable using them. But which factors are the ones that you typically see adjusted for that internal use?
I guess the factors that I see are the ones where something is changing. And I'm thinking about insurance coverages there as the thing that's changing the most. The other thing that, because experience is driving things differently, the experience could be because of legal factors affecting claims. It could be because of weather affecting claims. It could be all kinds of things that are driving you to have different frequency or severity of claims. But it also could be on the investment side because you've shifted and adopted some new asset classes. And maybe it's not, like a total night and day shift of classes to something that's completely new, but you've just started making different choices within an asset class to shift because different choices have become available. So you see adjustments that way. Well, one of the most interesting conversations I remember having when I was person in charge of an own factor model was with the investment department, where over a period of a couple months, we had a series of meetings where I was finally able to get them to understand exactly what we were trying to do with the capital model. When the light finally went on, they were able to say, "Oh, okay, now we know what your question is. The factor you want is 12.5%." I was like, "Oh, that's perfect." And in fact, that was a factor that made a new asset class on a risk adjusted basis look like it was in the mix, in the middle of all the other investment returns we were getting. So it made sense.
Creating your own factors for capital adequacy purposes expands on the NAIC formula based on unique preferences. Level of diversification, degree of risk. Are you analyzing normal volatility, a realistic disaster, or a near worst case? Or do you want to survive a cluster of multiple events? These factors need to evolve over time, communicating results up and down the ladder to better align strategies going forward. We hope you've enjoyed this episode of Crossing Thin Ice, presented by Actuarial Risk Management. If you found it valuable, please rate and subscribe.